Welcome to Something to Talk About from the Bainbridge Island Senior and Community Center. We're here with Jim Hopper, who's the director of the Bainbridge Community Foundation, and we're going to talk about giving strategies. It's that time of year, and this year it's particularly important to think about your strategies, not only for 2025, but for 2026 and beyond. Before we do that, I want to thank Fieldstone Communities of Bainbridge Island for being a sponsor of Something to Talk About. Fieldstone offers independent living, assisted living, and memory care communities up on Rolling Bay. You can find out more about that and their day stay and respite programs, and even get treated to a meal if you check in with Randy O'Neill or Sierra Wood. They're at 206 594 1010. The website is fieldstonecommunities.com. Also, we would like to acknowledge that we are meeting on the ancestral homeland of the Suquamish, the people of the clear salt water, who have lived on the waters of the Salish Sea since time immemorial. We honor them and are learning from their stewardship of these lands and waters to be better stewards ourselves. Thank you very much, Jim, for joining us.
Thank you. Happy to be here. Thanks, Reed. I really do appreciate that. They say that year end is the time to think about all of your charitable giving. For me, having just come off of a brutal flu or cold the last week, I feel like cold and flu season is the right time for us to think about our charitable giving. So when the sniffles come, that's when you think about where you're going to give to.
I mean,
Uh,
it's always valuable, but this is sort of the time of year based
yeah,
on both the tradition of tax breaks, although they aren't what they used to be, and we'll talk a little bit about that, and also just the spirit of the holidays often gets us thinking charitably.
absolutely, absolutely, and it's an important year. I'm happy to share to kind of dive right into this, where I'm going to talk a little bit about what's in this changing landscape.
Great. Go ahead and share your screen, and we'll take a look at the advice you have for us.
All
Okay, there
right,
it is.
there we go. Well, again, in 2026, so just pausing for a minute to reflect on the what has been a very tumultuous, I don't know, decade plus, where we have really been at a federal level swinging the pendulum one way and the other. And as a result, every year it feels like there's some new rules or something else that someone has to pay attention to. And guess what? This is no surprise. We've got this happening again this year. In 20, a major reset is on the horizon for our taxes, and that part of that is that the T Tax Cuts and Job Act, which boosted the deductibility benefit for charitable gifts, changes. It sunsets after 2025. Income brackets will revert to their pre-2017 level. And I will say that they have extended the benefit, the deductibility benefit, so that if you are making a cash gift to a nonprofit, it's deductible for 60%, up to 60% of your adjusted gross income, which is higher than it's been in years prior to the TCJA. In 2026, we'll also see something called a charitable floor, which means that any amount of charitable giving, if you itemize any amount of charitable giving that is uh, 0.5% of your adjusted gross income or less, doesn't count. So if you make $100,000 charitable gift, and your adjusted, or sorry, if your adjusted gross income, excuse me, is $100,000 and 0.5% of your adjusted gross income, you can give that much and it just won't count. And so this is a new thing that we'll see in 26. In addition, the standard deduction is going to be increasing slightly, up to 32.2 for married filing jointly, and 16,100 for single families. But new on the horizon will be something that we'll get to later called the above the line charitable deduction for non-itemizers. And that is going to be a super riveting part of our conversation later on, Reed.
I'm just on pins and needles. So
You're on, I can only imagine. I can only imagine. So why plan now? So the fact of the matter is there's things that people can do this current year, this month, this week, this day, that will be more beneficial than if they wait until next year to do their charitable giving. And I'll get to those in just a moment. The strategic giving tools, there's a lot of these different options out there, and for some people, one of them may be a good solution. For others, two or three of them may be a good solution. So I'll get to those. The three strategies that we're going to be talking about today, the first is donor advised funds, which I'll define in a moment. Second is qualified charitable distributions. And then the third is the above the line deduction, which is, as I said, new for 2026. So first, with donor advised funds have been around for several years. The Community Foundation's been administering them as long as we've been around. And it is a program by which you contribute cash, stock, or another asset to a charitable account at a community foundation. They also have them at Schwab, Fidelity, Vanguard, and other places. You get an immediate tax deduction when you make that contribution. And then whatever the amount is in that account, you can recommend where grants go over time. So if there is a particular year where you need a big tax deduction, you can open up that donor advised fund and then you can filter where you want those gifts to go over time. In 2025, this is particularly timely because of that charitable floor that I mentioned. That charitable floor will impact donor advised funds that are created in 2026 and forward. So if you want to ensure your maximum deductibility, make that gift in 2025. I'm going to go through just a few kind of quick case studies to talk about the different kinds of people that will benefit from different of these solutions. The first are the Nelsons. So they're in their early 40s. They earn around $115,000 a year, and they usually take the standard deduction. They're pretty generous folks. They give about $20,000 annually to local causes. But because their total deductions don't exceed the standard deduction, their charitable giving doesn't reduce their income tax at all. So what they're going to do is uh, it is open a donor advised fund and what we call bunch the dollars. So they'll be contributing $40,000, which is what they would be contributing over the span of 2 years. And they now bump into that level where they can itemize and they can benefit from the deductibility of that gift. And that in this case could be, as much as like $8,500 in more than the standard deduction, which is going to translate at the bottom to, 17 to $2,000 more in their pocket for giving. So bunching is a really helpful strategy. It's something my wife and I use ourselves because we tend to be just kind of close to the standard deduction, but not quite over there. So our charitable giving helps to bump us into that so we can maximize the tax benefit for that. Another example, the Patels have an adjusted gross income about $250,000. They give about $50,000, and that allows them to itemize. The couple's federal tax then drops by roughly $4,300 compared to not giving. So if they were to give $25,000 in 2025 and 25 in 2026, neither would exceed that standard donation, so there would be zero tax benefit. So here too is another example of how that bunching it can make a big impact. So by doing this before the 31st of this year, they take the full tax benefit that you receive in 2025. That means they avoid the charitable deduction floor. And if they have property taxes, mortgage interest, other things that they can donate, they can get an even more substantial federal tax savings as a result of that. So it starts to add up to real money when you look at all of these different scenarios. The Whitmores recently sold a rental property and wanted to offset their taxes. So they have a $350,000 adjusted gross income. Of course, no state income tax in Washington, but they're mindful of the capital gains tax. So by contributing $1,000 to charity, That's well within their 60% AGI cap. Their deduction would yield federal tax savings of about $16,000. If they wait until 2026, that same benefit would be reduced by about 1750 due to that adjusted gross income floor. So by placing it in a donor advised fund, they're able to take that this year, they're able to take that full deduction, spread their grants over time, and possibly reduce their Washington capital gains tax as well. So donor advised funds can really help with both the federal and the state tax situations. And the final donor advised fund case study, not all of us are in this situation, but Alex Rivera, successful biotech executive, has a $800,000 adjusted gross income. He's selling his company stock with significant capital gains and wants to give strategically. So Alex's $200,000 charitable gift via donor advised fund is fully deductible up to the 60% of AGI limit. It drops his federal taxes by about 16 to 17,000 and may also reduce those capital gains taxes. So in 2026, the same gift would be slightly less valuable, about $4,000 less because of that charitable floor. So front loading in 2025, as I've now said 3 times, is really an important strategy to take on. But not everybody is ready for a donor advised fund, and we totally understand that. And so I want to also talk about qualified charitable distributions. Many folks in this community, because we are a community where there are a lot of retirees, are familiar or have heard the term qualified charitable distribution. This is only available for IRA owners age 70 and a half or older. It's limited to up to $105,000 per person that can be given directly to charity. It counts toward your required minimum distribution. So there's a certain amount of money that you have to take out of your IRA when you hit a certain age. You can use up to $105,000 of that given directly to charity that won't count as your income as a result of that. And I'll talk about why that's beneficial in just a minute. The thing to remember, though, is that qualified charitable distributions cannot be used for donor advised funds or private foundations. So giving to the Senior Community Center is a great solution for that.
Or other charities in town that you care about, but it has to be a 501c3, right?
It does have to be a 501c3. So the case study I'll use here are the Hunters. They're age 70 and a half, retired teachers here. In 2025, they have to take their first retired minimum distribution from their $550,000 IRA, which is about $20,000. If they withdraw the $20,000 and donate it to charity by check, so their adjusted gross income rises to $90,000, or from $90,000 to $110,000. Because they take the standard deduction, they also have no tax benefit for this. So that higher AGI could raise their Medicare premiums and could result in a higher Social Security taxation. But instead, by making the $20,000 gift directly from the IRA as a qualified charitable distribution, they keep their AGI at $90,000, which saves them about $2,200 in federal taxes and preserves their Medicare income bracket. So it's an important strategy for people to think, especially if they don't necessarily think that they're eligible or that it will have a positive impact on them. Another scenario that I want to talk through is Ms. Martin. So she has what's called the widow's penalty, and
Okay,
that's
I don't
not
know if it's that. There we go.
all good. Um, I that is not an official term, but that is what happens when one spouse passes, and even though income into the family, especially in the beginning, may not change substantially, suddenly that widow it goes from being a joint filer to a single filer, which means that more of their Social Security could become taxable. It could result in higher Medicare premiums, and they could see a loss of credits or deductions that are related to adjusted gross income. And so specifically for her, she has a $900,000 IRA, which generates about a $34,000 required minimum distribution. If she takes it all as income and gives the $15,000 from her checking account, as we talked about with the previous scenario, her AGI jumps from $80,000 to $114,000, moving her into a higher tax bracket and triggering up to 85% taxation of her Social Security benefits. But if she sends $15,000 directly to charity as a QCD, only $19,000 of her required minimum distribution is taxable. Her AGI remains near $84,000, saving her about $2,500 in federal tax and reducing how much of her Social Security is taxed. So, especially when you're doing estate planning and as a married couple filing jointly, when you're thinking through that, it's important to start thinking through these scenarios before the spouse passes, so that you can avoid that widow's penalty. Um, also share the levies. So they have a combined IRA balance of about $1.5 million and an RMD of about $68,000. They typically give $40,000 a year to local and national nonprofits from their checking account. Their AGI stays at about $150,000 and they get no deduction because they get no special tax deduction on their contributions because they take the standard deduction. In 2025, they decide instead to direct that $40,000 directly to charity as a QCD. It satisfies most of their RMD while excluding about $40,000 from their taxable income. That means that their adjusted gross income drops to roughly $110,000, saving about $4,800 in federal tax and keeping them well below the next Medicaid surcharge threshold. So it's a very sage strategy at multiple income brackets to think about how your qualified charitable distribution can help save you federal taxes while expanding your charitable goals. And the last item I want to talk about quickly is the above the line deduction. So this is new for 2026. And what it does is it allows people who are taking the standard deduction, so they are not itemizing their deductions, to deduct up to $1,000 for a single filer or $2,000 for joint filers uh, of their cash gifts deductible above the line. Sorry, that doesn't sound that sounds more confusing. So if you make a gift to charity in 2026 and it's at least $1,000, or it's up to $1,000 if you're a single filer, or $2,000 if you're not, you can deduct that. You'll have a special line on your taxes where you can deduct that amount. So it's the standard. So think of it as you get the standard deduction plus whatever you give up to $1,000 for an individual or 2,000 for joint filers.
So
So
it's a little incentive to promote charity for people who normally wouldn't be able to make a deduction.
that's right. That's right. And it's one of those things that it's almost a tragedy if you aren't able to do that, right? Because if you're of the financial situation where you can make a charitable gift, then there's no reason not to benefit from this program and to try to maximize that charitable giving that you have. So just things to note, this applies to public charities only, so not donor advised funds or private foundations. But it will lower your adjusted gross income slightly, which improves your Social Security and your credit thresholds. Um, so seeing this in real life example, we'll look at the Jacksons. They are married, filing jointly, make about $95,000 a year. They give $2,000 in cash to 501(c)(3)s. They're without the above the line deduction, charitable giving doesn't change their taxable income. They take their standard deduction and leave it at that. But with this new above the line deduction, they can deduct $2,000 which lowers their income from 95,000 to 93,000. At a 12% marginal bracket, that saves them about $240, which is not an insignificant part of the overall gift that they gave.
Yeah.
Looking
So
at,
that's good. I mean, it seems
yeah,
like that's something you should not forget about.
absolutely. And it's something I think it's important both for nonprofits and donors to be aware of, and to share that information. Just giving an example, Joe Smith, single filer, a modest income of $60,000 a year, gives $800 in cash to nonprofits. Again, under pre-2026 law, his $800 would not count for taxes. But if he claims the full $800 above the line deduction, that reduces his income from 60 to 59,200, and a 12% bracket that saves about $96. Which again, $96 covers a trip to the grocery store, right? So it's important for us to be thinking through these different scenarios. The final example I'll give is the Perez family. They're a little bit closer to the adjusted to the area median income here. Um, so they have about $24,000 in other deductions. They give about $5,000 annually. Their $5,000 charitable gifts would not be deductible unless they bunch those up over a course of years. With the 2026 above the line deduction, they can still take the standard deduction and claim that $2,000, lowering their taxable income from 160,000 to 158. And at the 22% marginal tax bracket, this saves about $440. So these strategies really do help add up. Um, the message to take away from all of this is that 2025 is a year for donor advised funds. If you've heard me say that once, you've heard me say it about 35 times on this call. Um, and moving forward, both for this year and beyond, qualified charitable distributions, terrific ways to reduce your adjusted gross income and meet your required distribution efficiently. And then for 2026 and beyond, making sure that that above the line tax deduction is a part of your overall giving strategy. Um, tax laws will come and change and go, but new opportunities will always be there. Always consult with a tax professional. Your individual situation may resemble someone like this, but um, it is important to make sure that it's a match for you. You can match your strategy to their stage of life and income. And of course, BCF's super happy to help structure gifts that maximize both impact and advantages.
So you have a couple of events coming up. If you want to go over this again and in person and in more detail, November 3rd at 5:30, and November 5th at 11 a.m., both at BCF.
That's right. At BCF, 299 Madison, where the big blue chair is out on the road.
Yes. And you're requesting RSVPs by Friday, November 1st. No, Saturday, November 1st. Is that right? Yep. And I guess just call 206-842 0433, 206-842-0433, or send an email to Nicole, Nicole, at bainbridgecf.org. But of course, if you're catching us later than November 1st, you can certainly call or contact BCF anyway, right? Because it says right here, you're happy to help structure gifts to maximize impact and advantage.
That's right. We're always happy to talk. And even if you don't expect you're going to do anything, we are here to help people think through this stuff and to be a resource for you.
And that would probably make sense. In addition, as you said, the best person to talk about your specific taxing situation is a tax professional, but
That's right.
getting a sense of what you're asking makes sense beforehand.
That's right. That's right.
Okay, well, thank you very much, Jim. Very
Thank you,
helpful, and
Reed.
I appreciate you keeping those of us in the nonprofit world aware of these things as well, because we often get those questions too. So
Yeah, happy to do so. Thanks so much for your time.
thank you for